Let's talk a little bit about real estate and why of these investments it is my favorite investment, and there's a ton of reasons, but um, really quickly, this is a chart from the Federal Reserve 2012. The average tenant has a net worth, and again, that's the number that we're trying to track, that we're trying to build, that we're trying to, like that's our measure in the game, or for keeping score. Has a net worth of $5,100. The average homeowner has a net worth of $174,000, and on the next slide, I'm going to show you exactly why that is. So this is a really simplified how do I say, a really simplified graph of how wealth is built through real estate. And then I'm going to go a little bit further of how you actually, like I said, build on that more. So one of the things I'd like you to think about is, and again, this is in my opinion, and I see familiar names on this. Some of you may have heard me say this already. We live in society today where everyone wants something tomorrow. They want something right now. We live in everything is about instant gratification. No one thinks about the long term. It's Willie's telling me I have to wait 10 years or 20 years. Or you're still going to need money in 10 years. You're still going to want to be wealthy in 15 or 20 years as well. So I would encourage you to start now. Do what you have to do now, so you can live comfortably at one point and say, yeah, I built something in my 20s, in my 30s, in my 40s. So when I get to that 50 and my bones start to ache and I don't really want to work anymore, and I want to start to slow things down, I want to spend more time at home, you will get to that point and you'll be glad that you did the things today that you had to do to build a comfortable life for you down the road. So when I say that, the reason I'm looking at this is I get a lot of slack from the timeline on this chart. But when you're thinking about wealth, it's a long-term play. There is the get-rich-quick things. I would encourage you to, if it seems too good to be true, it is. Leave it alone. Real estate is something that I'm a big believer in. It takes time. Most people don't want to do it because the return pays off down the road. But I can tell you that 10 years into it, I wish I started 5 years earlier. And like I said, I don't see myself ever getting out of this business. But that's a side note. Let's talk about this chart right in front of us. Basically, this is what we call equity buildup. This is how you build. Remember, your net worth, or what you're worth, is your assets minus your liabilities. So in this chart, you're basically looking at year one, down the bottom, 20-year timeline, year 1 to 5 to 10 to 15 to 20. You're basically looking at year one. This lady bought a home for $300,000. And she, at day one, put a $50,000 down payment. The home was worth $300,000 in year one. She put a $50,000 down payment on it. So immediately, her equity in the property was $50,000. It was worth $300,000. Put $50,000 down. She only owed $250,000 on her mortgage. If she sold the same day or the next week, she can sell it for $300,000 and walk away with $50,000 that she put in. She didn't. She held on to the property, and over time, the property appreciated. Which real estate tends to do. Again, some people say 2008, 2009, rough years, but over long periods of time, real estate tends to to go up in value. In this particular example, she started off with a value of $300,000. The property appreciated at a 4% on top of each other. It's 4% every year. And remember that compound interest does have an effect on this. At the end of 20 years, her $300,000 home was worth $541,000. So that's increased in value over that 20 years by $240,000. And 4% is relatively conservative. On the other end of that, she was also paying down her debt. With every mortgage payment, her debt or principal balance in that mortgage was being decreased. You pay your landlord allows you to stay there for another 30 days. That's it. You get nothing back. With each mortgage payment, you are actually paying down principal in your residence. So over time, a portion of her mortgage payment went to interest to pay the bank for the ability to use a loan. A portion also went to paying down that mortgage. At the end of 20 years, she ended up with a mortgage balance of $117,000. So I had it on here, and I don't know where it happened. I'm going to try to do math really quickly. Let's round the numbers, and let's say you're looking at 540 minus 120. Is that 320, Patrick? 420. So she's built up about $420,000 in equity in this property over that 20-year time span. So this is her most likely her primary residence. This is where she lives. It's not an investment to her. It's her primary residence, but she was building wealth. So let's say she wanted to retire at the end of that 20 years, or she wanted to cash out, or say she even wanted to cash out at the end of 15 years. You can sell real estate at any time. She can walk away and sell that house in its current market 20 years from then, and in the current market for $540,000. Pay her real estate agent, pay her attorney, pay the fees, and probably walk away with close to $400,000 in her pocket and do whatever she wants with it. Move to Florida, move to Italy, do whatever she wants to retire comfortably. She would probably need some type of other place to stay. Maybe she stays here. So this is one example of how you can build up $400,000 just from paying down your mortgage and having the property appreciate. Let's think about it. And again, I don't want to put too much. It's not it's a wealth building seminar. I want to have multiple concepts in here and not focus too much on real estate. But really quickly, think about the fact that, or think about the idea of actually owning multiple properties. What if this wasn't her only piece of property? What if this was one of 4 or one of 5? She can easily be worth a couple $1 million collectively in real estate. Think about the idea that, what if she, in this particular example, she was probably making the mortgage payments with her income. She goes to work, they pay her, she pays down the mortgage, she builds wealth. What if you actually had tenants paying down your mortgage simultaneously as well? Your tenants, with each payment, are paying down your mortgage. The property is simultaneously appreciating, and you're building equity there. What if your tenants were not only paying down your mortgage, the property was appreciating, but your income from the property exceeded your expenses, so you're also putting money into your pocket, i.e. cash flow. Your mortgage is $3,000. Your tenants are paying you $5,000 a month in rent every month. So your mortgage expenses, taxes, insurance, $3,000 a month. Your tenant, you're collecting $45,000 or let's say $5,000. Keep the numbers simple from your tenants. You now have appreciation through the building. You have debt paid down by your tenants, and you also have what's called cash flow at the end of the month coming from that property. If you do that with multiple properties, you can see how you can build a substantial amount of wealth over time. Let's say this example is her primary residence, but she also owns 2 other rental properties. She wants to stay here, but those 2 other rental properties did the exact same performance. Now she can cash out, year 20 and walk away with $800,000 and move to wherever she wants to move, or stay where she ever wants to stay. Use that money to pay down, or live off of, stop working and live off that $800,000 relatively easily, or keep the property and live off the cash flow just as easily. And the last thing I would like to mention, and the reason I'm a big fan of real estate, is not only because of 4 factors: the appreciation, the debt pay down, the cash flow, and then the tax benefits that come from our real estate ownership as well. I don't want to go too much into that, but there are a ton of tax benefits. You can you reach them up between having the mortgage interest be tax deductible, from all the write-offs that you get from owning property, from technically, if you are a landlord, you're also a business owner as well. So I take my wife out to lunch, or take my wife out to dinner, and we talk about rental property. We talk about the newest rental property that we bought. We talk about the newest what we're going to do, or the conference that we're going to. That is a business lunch for me. That is a business expense. That lunch is written off, under, I pay for it with the rental property bank card. That lunch is an expense. So between appreciation, debt pay down, the equity build up, the cash flow that comes from the property, and the tax benefits, it's a great investment. And if you look back, and I don't want to sell it too hard, but if you look back and we realize that inflation is eating up our purchasing power on a monthly basis. So we realize that if we don't invest, then we're actually losing money, or like I said, we're losing purchasing power. So we understand that we have to invest. If we have to invest, and we look back at our investment options, and we say, well, stocks, somebody else is in control of that. Somebody else in corporate America has that option. Whether that stock performance, I'm contingent upon Apple or Home Depot or McDonald's to do well, for me to do well. Bonds, I'm going to get a stated interest rate, conservative approach to putting something together. Mutual funds, combination, somebody else is still managing it. My performance is going to be contingent upon, my retirement is going to be contingent upon the performance of someone else. Precious metals, antiques, and collectibles, don't leave me too many options. If you look at these investment types and you think about all the things that real estate brings, that's why I'm a big fan of it. That's why where Boston Wealth Builders came from, and a lot of other things, that I, do in my life are circled around that, that investment in real estate. I don't see any other questions, so we'll talk about tax-deferred savings. Actually, hold on one second. Yep, okay. Tax-deferred savings versus after-tax savings. One of the last concepts we want to talk about, I believe today, is tax deferment versus after-tax savings. And there's no hard and fast rules to that. This is what I want to get out first. There's no rule that says you should try to put as much away as you can into a 401k or an IRA because it's tax deferred, and you should leave yourself very little. I think that real estate is an investment that you're not going to be able to buy in your 401k or not going to be able to buy in your IRA, and it's still a great investment. You're going to have to pay, with after-tax dollars. But understanding the difference between, tax deferred growth and after-tax growth is very important, and you can determine whether you, in your financial situation in your life, and I go back again all the way back to the beginning where I'm talking about having a good grasp of your income and expenses in your household, having that financial plan or that financial planning software that helps you understand your situation. These type of upper level decisions that you're going to make with your finances can have a huge effect on you. But if you don't have the foundation, if you don't understand where you are in the game, what your cash option is, what money that you have in investments, you won't understand how to make these type of decisions, whether you want to put more money into your 401k, whether you want to take money out. And people constantly come to me and say, well, is it better for me to do more money in my 401k, or should I keep it invested? Unless you have a full understanding of someone's financial picture, none of these things. I listen to Susie Orman and some of the the talking heads about finance, and they come with these hard and fast rules, but I'm not a fan of that. I think that with each one of these financial options that you have, you're going to have to determine where you are in your life, your finances, your family's finances, where you're trying to go, where you're trying to get to. Because that's the other thing. We're not all trying to get to the same place. Some of us want to get to $1 million and be happy with that. Some of us want to, if they make a $500,000, they'll be ecstatic. Some of us want to be, billionaires. So this is all going to be, hitched on your financial goals, where you are in your life, and like I said, don't want to, beat a dead horse, but having that Quicken software, that Microsoft Money, that Mint, is crucial to understanding decisions like this. But basically, this chart is very simple. It assumes a $10,000 investment is put in. You don't put anything else in there. You just put it into your 401k or your IRA and whatever it may be, and you grow. Your tax rate is 25%, and the interest rate or the return on investment that you're getting is 9.69%. So if you got that in your 401k, your IRA, a tax-deferred account, that $10,000 over 20 years will grow to $68,000. If you took that same $10,000, it was taxed, and then you got the 10%, you're going to have roughly $26,000 less, in that same investment. The difference is, if you pull out that $20,000, that $68,000 20 years from now, you have yet to pay taxes on that. So what tax brackets you are, it's grown faster, but now you still have to pay taxes. Whereas you have the without the tax referral or the tax deferral, you have $42,000 that now you can use tax-free. So again, those are the type of decisions that are really going to be contingent upon your your situation and what you're trying to do. Quick question. Hold on one second. Yes, we will have a replay of the webinar, definitely. Am I familiar with Forex, which is the, I believe, the foreign exchange trading market? Good investment, all depends on your particular situation. I don't know too much about Forex. I'm sorry, Forex is the currency exchange, I believe, market. Again, that's something that you're going to have to, like I said, to research. I'd probably pick up a book, probably watch a couple of webinars. None of these things I would hop into without some type of good understanding on it. I haven't personally traded in Forex at all. And again, I believe it's the currency exchange option. Also, do you think it'd be down the line tax bracket wise? Where do you think taxes will be with all the status in U.S. government debt? Likelihood they will raise over long term. is pretty strong. So will taxes go up, or are income tax brackets going to change over time? That's something I really can't, comment on that. I can tell you that in my lifetime, they haven't changed much, but that means little. I mean, obviously with incoming presidents, a new president coming in, the national debt growing the way it is, I can't say. I really don't know. But I would probably be conservative and count on it going up. And again, it's really hard to say, because I guess if I said that, then tax deferred investments would be obsolete or just not as relevant. I like the idea, me personally, and again, you could take this as you will, this is my personal opinion, of diversifying. I'm big on diversification. I'm not going to be the type of person that's going to have $6 million in my 401k. I just don't think that's a good idea. I'm not going to the type of person, despite the fact how much I love real estate, I'm not the type of person that's going to catch everything that I have in the real estate market. I'm not going to put everything into my business. I'm going to try to diversify my investments, whether it be a little bit of what I have goes into my deferred, 401k or SEP IRA. A little bit goes into after-tax trading with my E-Trade account. A little bit goes back into real estate. A little bit goes into building my business. That way, if the stock market crashes, I still have real estate to hold on to. If the real estate market crashes, I still have this, to hold on to. So you really want to diversify yourself as well as possible. My personal opinion is I don't believe in one thing strongly enough that I'm going to dump 100% into that particular situation. So whether taxes are going to go up, I don't know. I would probably do a little bit, have that budget, create that budget, see where you are, put some of it into, your tax deferred plan, so you benefit if tax rates don't go up, and put a little bit into, that after tax, investments as well, so you're not totally lost there as well. I like Tony Robbins, Money Master, game book where he is top financial traders in the world. Yep, somebody had mentioned, Tony Robbins. I have yet to read one of his books, but I've heard, Money Master, I guess, is the name of the Money Master game book. He interviewed top financial traders in the world. Like I said, yes, something I have read. I have heard a lot about him though, and heard he's pretty good. Speaking of books, I have something for you though. This is a free book you can download. It says personal, finance for dummies. Please don't, they'll take that for dummies too personal. This is actually, something that's on my bookshelf. It starts you off with some of the, some great basics, some key principles that, you should learn before you start getting into some of the more advanced concepts. You can download this book completely free for yourself. Please share it with your family, your friends, loved ones, anybody you think could reference, from it. You can, like I said, text personal to 44222. It'll ask you for your email address, and then it'll send you over a PDF copy of the book immediately. And again, feel free to share it. I'm not sure whether I'm allowed to give it away or not, but I'm going to anyway. I already have, so just, please keep it to yourself. Like I said, I don't want to commercialize it, but like I said, it is something that you can download, and I've read it, and like I said, it is on my bookshelf. And again, it's a not some it touch upon a lot of different beginning concepts, and it's good. It's a good foundation for you. So let me go through the questions one more time to see if anybody else has anything, and then taxes, forex, replay. Yes, so like I said, we do have the replay of the webinar for those of you that came on a little late. Hopefully, some of these full. We talked about credit. We talked about personal finance software, life insurance, and like I said, I will have the replay for any of those who are interested. Probably give me a day, to download it, get it up on our YouTube channel, and then we'll send it out. If there are no other questions, I thank you for joining me this morning. Hopefully this was helpful. And last but not least, if I can help in any way, this is my email address, willie@mandrelco.com. I don't mind, like I said, giving my advice. I'm not a financial planner. I'm not a life insurance provider. Like I said, if you want to talk real estate, I do own a brokerage. We'd love to, to help you out and assist you in, like I said, buying, selling, if you already own, potentially, finding good tenants. Whatever you need help with, please, if I can't help you. Like I said, there are 900 members, or close to 1,000 members now in Boston Wealth Builders. I've met a lot of different people, from insurance providers to mortgage brokers to everyone else, financial planners. And like I said, send me the question. If I can't help you, I will try my best to connect you with the person that can within our network, and we can take it from there. So again, thank you for joining us this morning. Hopefully this was helpful, and I look forward to connecting with each one of you.